Well, good afternoon and welcome to our webinar, The CECL Journey, Regulatory Expectations for Community Bank. I'd like to introduce our speakers today, including me. I'm Peter Chirpak from Ardmore Banking Advisors. I am an EVP here at Ardmore. I've been here for 15 years. Before that, worked for PNC Bank. And I specialize in community bank, credit data management, and CECL implementations. Also, I'm very pleased to introduce Mike Gillette of the American Bankers Association, a true rock star of CECL industry experts. I actually call him CECL Doggy Dog sometimes. But Mike, welcome to the panel.
Hey, thanks a lot, Peter. I appreciate it. If you want to call me Doggy Dog, that's fine.
Great. Okay, so I'm just going to introduce quickly my firm, Ardmore Banking Advisors. We are a full-service credit consulting firm that has been supporting community banks' credit risk management for over 25 years, and we've been partners with CSI for 7 years, helping CSI with credit risk and commercial lending issues and support. And Argus Information Systems is our software provider, which has been offering compliance solutions in software development for over 20 years and is headquartered in White Plains, New York. They're the ones who have built our full software platform for CECL. So what are we going to talk about today? Well, we're going to do a very brief overview of CECL. I think by now, most all of you on the phone know what CECL is, have attended webinars and the like, so we're just going to hit some high points. We're going to focus on this Ask the Regulators webinar that was held at the end of February, which is really the first time that the regulators came out and made commentary specifically for implementation issues for smaller, less complex institutions. Specifically, we're going to look at some of the key points that they covered, and Mike's going to give us some comments as well. The first one was start now, then the whole issue of the loss rate calculation methods you can use, including some simple examples, some of the challenges that smaller, less complex institutions face with doing the loss rate calculation. Also, the whole issue of data. Of course, we have to talk about that. And controls, documentation, and justification. Those are the key points we're going to speak to. And then we're going to sort of go off the grid a little bit and say, well, what do we do with this information? Where do we go from here? And talk about the CECL journey and briefly look at some of the solutions that we offer to CSI banks in partnership with CSI. So let's get started. And I'm going to give you the 2-minute view of what CECL is. A principle-based rule, and current expected credit loss is what CECL stands for. And when I say principle-based, I mean it's extremely subjective. The rule by design was meant to let the institution choose choices around how they construct and support their ALLL, and there are a lot of decisions that banks have to make. And it's all up to the bank's ability to do the very best they can and justify their decisions. It is an accounting standard, not a regulation or a law. So that's important to understand. I think a lot of banks think of this as a regulation and therefore keep looking to the regulators to define how they want the banks to react. In reality, it's an accounting standard. So it's really the accountants who've decided this. This is also the reason why you won't see this in any Dodd-Frank rollback or any other regulatory change, because it's not a regulation. The idea, whole concept of CECL rules was to be proactive and countercyclical, so that as opposed to looking backwards at historical performance and basing your reserve on that, you're actually looking forward. We were under-reserved during the last crisis because we'd been looking back and not had any problems. Then we were sort of over-reserved when we came out because we were looking back at the problem loans even though things were good. So the attempt of the CECL rules was to try to get rid of that lag. It's based around one of the main concepts is LOL, and that's not the LOL that your kids text. This is LOL, life of loan loss. So one of the main concepts is coming up with what you believe the life of loan loss is for the asset and booking that life of loan loss at the time the loan is booked. And then you have to add a projection of what you think the future losses are going to be based on economic conditions. Those projections include a reasonably supportable economic-based projection of future losses. And that reasonable supportable is really up to the institution to define and justify. After your projection period, you're supposed to revert to historical loss rates. So it's really a multi-phased process of doing estimates of losses. And in most cases, we are being told that the best practice is your loss projections should be based on loss patterns for these asset types or pools based on historical economic metrics. So this is where we get into some of the data requirements. So there in 60 seconds is what CECL is. I don't know, Mike, if you want to add anything to that.
Yeah, that's a pretty good quick summary. I think that what's interesting is that those items like reasonable, supportable, economic-based projections, and then reverting back to historic loss rates. It does tell you something about that. Not just an amount, but kind of the timing of those amounts can be important in that, and so that's why FASB kind of put those in, because of the struggle of trying to get further than a year or two out there. So, but the timing has to be. We'll probably discuss that a little bit later in this hour. Thanks.
Right. Okay. Well, one of the things I sort of wanted to dispense right in the beginning is that, and this may seem strange coming from a vendor, although we think of ourselves, Ardmore, as more of a consulting firm helping institutions with the problem, but you're not going to be able to buy CECL readiness. CECL readiness is really something that the institution has to do themselves. The risk is the bank's risk, and it is part of the board's responsibility. So unfortunately, I think a lot of people think they can just buy a turnkey solution. And while solutions are available, including ours, really there are many steps to CECL compliance. So just to give you an idea, the first step, most likely, is taking a look at the data that you have versus the data that you need, and establishing what your gaps are, and really doing remediation of not only the data itself, but the practices and processes of generating it. After that, you're going to need to gather historical data, and you have to figure out where you're going to store it, and you have to map it into whatever calculations you choose to do. You also have to take a look at macroeconomic behavior and collect macroeconomic indicators and consider that versus actual historical losses. You have to establish governance, policies, controls, and support documentation, similar to what you have for the ALLL now, but now that the sources of information have expanded and the process has gotten more complex, there'll be more of this required. Eventually, you're going to look at the different approved methodologies for calculating the ALLL losses, and you're going to have to pick for each pool the best way to do it. And you have to define your reasonable supportable projection period and what the process is that you'll use and justify for your projections. And then obviously this has to be repeatable, and you have to have ongoing validation and control processes. These are not things that you can buy necessarily in a software. Some of these things you can, but it is a many-step process. So I think that it has to be very clear in the minds of the people here listening in.
Yeah, Peter, this is Mike. I wanted to emphasize that the title of this presentation, the CECL journey, is such an accurate description, because all those processes that you just described are, first of all, they're daunting, it seems like, when you first look at them, but they're also things that you're probably going to have to do over many years. Those things you're going to be continually assessing and continually refining and such. And so, think of it as a process where you can learn. And I think that as banks get into this, you in your learning process, you need to plan for things like, is there growth in your portfolio that you're expecting? Are there changes in management? Whatever your management says now, there might be different in the future. And you have examiners who might tell you one thing, and they might change their minds. The regulators, just the regulatory environment might change, and just markets, things like that. But fortunately, technology will probably get better. So I think that during this journey, I think the best thing to do is just to think about it with the most open mind, trying to put in the most flexibility for that matter, because I think things will change, over the next, 10, 15, 20 years. So anyway, that's me.
I think you're right, Mike. I mean, we heard certainly at the AACPA that regulators said, we're not going to put up the guardrails until the road is laid down. And that kind of took people for a bit of a surprise, but we are still laying down the road on this journey.
Indeed, indeed.
I should add that you can ask questions. You can submit them through the question panel on the GoToWebinar control panel. So if you do want to ask some questions of Mike or myself or both, you can type them in there. And if we don't have time, we'll get back to you via email. So let's talk about this webinar. This is really important because, and I know Mike and I discussed this a lot, that we weren't getting much direction. Bankers were waiting to act until they heard from the regulators that this is something they really did have to do. And for a while, the messages that were coming were kind of hard to understand. They were saying things like, you really don't have to do anything if you're really small. You can kind of do what you're doing now. It's not a big event. And we know that that's not really completely accurate. So we were pretty surprised. So this is a departure, and we're actually getting some practical direction. But as you'll see as we go through this next segment, it's not all super clear yet exactly what their intentions are. So let's get into it. This is the webinar opening, and you can see the different regulatory bodies that were represented. For those of you who attended, you know these names now. The title, using the term smaller, less complex community banks, when asked what that means exactly, the response was that we're not defining it because we don't want to cut banks out or put them in. So you can take that for what it's worth. But less complex community banks apparently are banks that do less complex things. But let's move into some of the substance. They did have a couple of warnings. One of them was this one, which said what's not included in today's section. They're not going to talk about data management, qualitative adjustments, or segmentation, which are three very, very important topics. They ended up talking about two of them, actually, but they did make that disqualifier. Also, this slide was put up several times during the presentation as a warning with these scary-looking exclamation point signs. Essentially, they're saying this is just a starting point for CECL, so they were trying to make a similar statement as I did with the stair steps, that this is not a completely complete example of all the CECL calculations, and there's not a safe harbor suggesting if you just follow what's in this presentation, you're good to go. And of course, my favorite one, which is the one at the bottom, which says there is no one method that is appropriate for every portfolio. So they put a fence around what they were going to say. So the key concepts I got out of this, and I'll ask Mike if I missed anything that he can think of. The first one they were trying to make quite clear is that a bank can do CECL calculations, the loss calculation, in a lot of different ways. And some can probably do it on a spreadsheet. I think that's probably true. However, when you look at the sum of the entire thing, it's daunting is the word you use, Mike. I would tend to think so too. But that was a point they were definitely trying to deliver. Creating a reasonable, supportable life of loan estimate is very difficult and challenging, particularly for smaller institutions. We'll talk about why that is. So you notice I'm separating that out from the loss calculation. You first have to calculate a life of loan loss for your asset pools, and that in itself, they explained, was very difficult. This was a little surprising to some of us, maybe not surprising in the answer, but the fact that the regulators actually said it. But several times they said you're going to need some kind of data warehouse to hold and manage in a controlled fashion the data you need for CECL. That they specifically called out spreadsheet management of data as not a best practice, not recommended, And that is the default for most smaller, non-complex institutions. So it was interesting and a little surprising that they said you should not be doing that. They also stated that a bank's internal data will probably be insufficient to do CECL, particularly a smaller institution, and they explained why. This again was a little surprising because they had been saying that you really don't need to buy anything and you don't need to do anything different. Well, if you have to go out and acquire third-party data, I would say that is a little bit different. And finally, they did not cover anything about managing Q factors, creating them, or how to do forecasting at all. So that was not covered, and that's probably the most complicated part of CECL. But these were my main takeaways, and we're going to kind of go into these in a little detail. Mike, is this pretty much the way you saw it?
Yeah, I think that bullet point 3 and 4 seemed to be the biggest things that they really tried to kind of go off script and talk about. And so, I think in regards to the data warehousing, it's not so much the they want to emphasize that it's not so much the calculations that were that complicated. It's just how much data needs to be that eventually, for example, gets into a loss rate is from. And so, for example, if you have a C&I portfolio, you're risk rating them, and you say, level 3. What would an expected loss rate be? Well, it kind of requires a quarterly snapshot of your portfolio through the rest of the life on each of those 3 rated loans, and then keeping all 3 rated loans over time is a lot of data. So that's where that tracking comes to be a big thing.
Right, yeah, that, and they kept talking about the loss patterns and needing to create loss patterns that you could then extrapolate or draw conclusions from or correlate to, and that implies history and depth of data that's outside of the scope of what most banks do.
Yeah, definitely. I mean, the loss patterns, they also, during the discussions FASB had back from between 2010 and 2016 when they were going through all this stuff, loss curves, they were referred to as loss curves, and part of those loss curves, for example, are for like a residential portfolio, you hardly get any losses at all after a loan's about 5 or 6 years old because they've built up equity in the house. So, it's actually referred to as loss or risk pattern or loss patterns within the standard there.
Oh, that's right. It is something they refer to. That's true. All right. Well, so first key point was start now. This was the official firing of the starter's pistol for any bank that said, I'm waiting to be told by a regulator that I've got to do this. Well, they're saying you've got to do this. And they're saying the first thing you should be doing is collecting risk characteristic data for CECL and creating a retention plan. Another way to say that is to say risk characteristic data may be information that you're not either populating today in your core or in your loan origination process, or it's data that you are populating but you're not retaining anywhere or using. So for example, when I look at some of our early adopter banks from CSI, I'm looking at control categories, I'm looking at collateral codes, NAICS codes, purpose codes, some of these things, including borrower characteristics like LTV at origination, risk ratings, debt service coverage ratios, credit scores. So these are risk characteristics, and you have to start collecting them now. You hopefully have them in your history, and you need a plan. Another start now is, sorry, Mike.
Yeah, I think a lot of that, what you're just saying is within the origination process. So those are the underwriting standards there, and they're just never normally transferred over to the servicing system. So it's that process of getting that data that just hasn't been transferred over.
Right, and I think for a lot of the people on the phone today, we're talking about Word documents and Excel forms and things that are never maintained. And this whole idea of getting started now, that you may not do a great job in the first go round, but that there's an expectation that you will get better over time. How good a best effort is, I think, is something that an auditor would kind of chime in on, or an accounting firm, your external auditors, as to what connotes a best effort. The regulators were a little nebulous on that. Now's the time to create a cross-functional CECL project team and a CECL implementation project plan. I think there is an understanding it's not going to be a detailed project plan. The early must-dos, which is something I covered in one of my earlier webinars, obviously are the things to focus on now, but you should start to sketch out an overall plan and get the buy-in of all the different stakeholders involved. There was a statement about you can use a vendor for your loss calculations and for data management, but you should look at your current vendor's data retention. And the good news on this is that CSI has stepped up, particularly on the New Point side, and archived multiple years of data. We talked to them a couple of years ago about this as an early important step, and they did that. So the banks that choose to use the solutions that we have are going to have the benefit of some of that historical data. But of course, if you don't populate the fields, if there's garbage in, there's going to be garbage out. So we can take your history, but if you didn't populate the fields or do it consistently or with quality, then it may or may not be something you can actually use.
And and that's Peter, if I can stop you there, if the bankers that we talk to, and this is for banks of any size, that's one of the biggest challenges that they're finding in the implementation process is that the quality of the data, sometimes fields, they change during, between years of what the purpose is and things like that. So a lot of times you get a lot of garbage there. And so there's a considerable amount of cleanup to be expected there.
Yeah, and Mike, just so you know, in CSI, there's a bit of a challenge because banks are allowed to define a lot of their own codes. And that makes for a real challenge when you're trying to aggregate data and create patterns of historical performance.
Right.
Point, they made it quite clear, no matter how small you are, no one is exempt from CECL. So any last hope the smallest institutions had of saying, well, we're going to get exempted or they're not going to make us do it, I'm afraid that's just not so. The second point was they started talking about loss rate calculation considerations. And the first thing that they said was that they don't consider that the loss rate calculation itself is that complex. The math to calculate a historic loss rate or life of loan loss is not that hard, and you could use a spreadsheet to do it. I kind of think of that as like saying I'm in Missouri and I need to go to San Francisco. I could walk there. Certainly could. But the amount of resources that it would take would be significant, and it would be probably pretty painful.
Yeah, I was controller of a life insurance company way back when they had a similar kind of industry-changing standard, and we did a lot of stuff. We did most of everything that we did on spreadsheets, and I don't know how many times my spreadsheet links got corrupted, and I change a formula, or I didn't like one answer, so I try to see some other assumptions. That got messed up, and so yeah, it's a little more than what I think they're leading us to think.
But I mean, again, it's something you could do. They do also then turn around and say, calculating the actual average life of loan pool or life of loan is the difficult thing, particularly with minimal historical data to work with. And they had some very specific examples of the challenges of that.
Yeah.
They also said, very instructively, the current incurred loss pool segmentation that you have may or may not be acceptable. If your current pool segmentation process is risk-based, meaning that you take the control code and you break it out by regulatory risk category, or maybe even credit score bands or something like that, then it's certainly acceptable. If you just use the call code or the control code, that may not be acceptable, and they did not weigh in specifically on that either way. They also said one calculation method is not necessarily better than the other. So there are several calculations, and we're about to look at some of the ones they offered. But they didn't say that one was better than the other. They did mention specifically vintage, which is a methodology that looks at snapshots based on origination quarter over time, and that they work well for homogeneous loans that are more predictable in behavior like consumer. So these are some of the things that came out. A couple other comments that, this life of loan calculation is a starting point, but is not what CECL is all about. It's about doing your very best estimate of life of loan loss for the credit. It's not just about doing the calculation. That you really should look at the CECL implementation as a holistic process that involves different areas of the institution, different people, decisions, and practices. They showed a new kind of calculation, which we're about to look at, which some people, including I think Mike and I, are not really sure how CECL compliant it really is, but they showed that there are many different ways to do the calculation. And they also said that they're not going to talk about Q factors. And I thought that the interesting part of it is the regulator who said that said, we're not going to talk about how Q factors are going to be used and justified, because that would make this webinar go on all day, which I thought was kind of funny. And now I'm going to put up my quote from Mike, which I used in this presentation, and I'm going to ask him to explain it. But I thought this was a very astute comment, which is to say he is echoing the fact that the regulators tell you that CECL is easy. It's just easy until you get the answer that you don't want. And Q factors and the assumptions that underlie them, it will be probably how you're going to adjust the answer that you don't want to an answer that you can accept. So Mike, can you amplify a little bit on what you mean?
Well, yeah, I mean, it goes back to, what is now the Q factor process. I think that one of the challenges, probably the biggest challenge we have with CECL is, currently your Q factors, you usually adjust them with directional consistency with, what your credit metrics are. Your past dues or your classified loans go up, and your provision usually goes up, right? And and usually proportionally too at some point. That goes away under CECL because you should be recording all those losses up front. So you've effectively anticipated all of the past dues or all of the classified loans and such. And so in order to do a Q factor analysis in CECL, first, you got to get over that hump of the directional consistency. Second, you also have to address now that you're doing things for the life of the loan, so it's a much bigger playing field as opposed to what is essentially, kind of over the the next year and such. And you also have to kind of explain that coherently within the disclosures. It's even, the disclosures even have what is described as an MD&A within it. So it's more of a challenge. And so when you get the answer you don't want, you start ending up going into a lot more detail and end up using different assumptions, and those assumptions require some kind of quick way to process all that stuff. So this is another thing I could go on, well, maybe for another hour or whatever, but yeah, this is a challenge.
Yeah, and based on what you just described, just to give an illustration, if you had done a life of loan loss calculation that you're going to increase reserves for particular asset types because you anticipate an interest rate rise and a lot of increased delinquency, and that you do get increased delinquency, but not quite as much as you planned, you'd actually reduce your reserves even though you had increased delinquency. So it's kind of a wrinkle. All right, so
Yeah.
let's talk about, there are simple loss calculations that were presented and asked the regulators. And you notice that they circled current forecast, not today's focus. So they basically showed three types, and I'm not going to go through this in detail. If we were going to do a detailed walkthrough of all the CECL calculations, then we would be going for quite a while, but do want to highlight the ones that they showed. The first one, they titled Snapshot Open Pool Method, which I think we in the industry have been calling a closed pool method for quite a long time, so I got a little confused by that.
Indeed,
But
indeed.
Yeah, in essence, what they're saying is you don't do an average over the life. You take the actual charge-offs associated with the pool, you add them up, and then the interesting part was this 25 basis point qualitative adjustment that they threw in there that was not explained. But basically, they had you add up the losses over the life, divide it by the original balance, and then come up with an actual historical charge-off rate. Then you just throw in a qualitative adjustment, and off you go. That was the first method that they showed. The second one was the one that we all found kind of curious. That was this estimated remaining life method, where, according to their suggestion, you would actually look at historical repayment and use, well, here's what they said, I circled it here. Expected paydowns can be obtained from a loan system or approximated from asset and liability management practices. So the idea with this is that you were going to figure out what the actual paydown amounts and percentages were and then apply them to future years. It's kind of a strange thing because in a lot of cases, the actual paydowns, which include things like prepayments, charge-offs, TDRs, the pattern is not consistent. It changes based on the loss curve, which is something we talked about. This kind of makes it sound like there is no loss curve. I don't know, Mike, what you thought of that one.
Well, yeah, I totally agree. I think as we go through here and you think about different ways to calculate the starting point is something that you can much more easily then explain what your adjustments to that starting point are. And as you mentioned, Peter, with this remaining life method, you got prepayments that are going on, and you've got things that the loss curve that's supposedly somewhere in there, which I'm not sure where, but we think it is, right? And so it's very difficult to conceptualize how what you're adjusting from when you do this method.
Yeah. The third one is the one that I think that a lot of institutions can conceptually understand as a life of loan calculation, but the vintage model, which my understanding is that when FASB developed CECL, that was sort of on their mind as the probable way a lot of this would be done, where you take the origination periods of the credits and you follow the losses of those credits through quarterly in order to estimate life of loan loss and use that historical pattern to project. And then that's what they're showing. Example.
Yeah, they definitely spoke. FASB during their processes spoke a lot about this. In fact, they thought it was so important that that's why the vintage-based disclosures were required in that for the public business entities.
Right, and that's something that you're going to have to do and deal with the fact that multiple years of what we call disaggregation of data into vintages. I circled the step 3 here, which I thought was interesting. So it said, determine which historical loss period is a reasonable period based on the expected credit loss rate calculation. So it almost kind of does a tail wagging the dog thing where they're saying, well, you want to project based on what is the most likely projection. So you're supposed to pick and choose your loss period to use as a base for projection, correlating it to economic conditions. So these are the simple calculations, people. Don't even ask me about.
One thing I wanted to go back to the remaining life method and just warn you about that is that talks about, your asset liability management practices, and Peter's shown you told about, some of the issues there, but do you want to have that subject to your audit? And it would seem to be that just presents a whole lot more complexity because, ALM systems tend to break out things by term, by length of the contract and things like that. That I don't think you're going to want to. You would normally want to get into. It gets into a lot of detail you wouldn't want to do. And I think it also has issues where you could have, quite honestly, differences in your calculation just because the interest rates changed and nothing because anything else. So you try to explain that. It's a little tough.
Understood. All right. Well, let's go on and talk about some of the challenges. And I want to make sure we have enough time. We may run a little over time for questions, so for those who can't stay, we'll have a recording of this available eventually. So why would you be challenged to create these loss rates as they're being described? Well, obviously, one of the challenges you have is if you have minimal or no losses in particular segments, how are you going to create a loss pattern when there is no historical loss? That's a challenge. If they're very sporadic, so if you have 1 or 2 losses in a quarter and then none for a long period of time or something like that, it's going to make it very hard to establish any kind of pattern for which you can extrapolate a life of loan loss. Again, for smaller institutions, if you have a limited number of loans and data is only available for a short period, it's very difficult to use that to create a justifiable loan loss calculation. I quoted Bob Storch from the FDIC saying, if you have this condition, it typically means management needs to look to loan loss data from external sources such as peer data. And another comment they made was a challenge is that if you're trying to look at historical losses in loan pools, if you change the loan pool structure or composition, so if you're using the snapshot version or the closed pool version, and you used to have a lot of very well-seasoned credits in that pool, and then they roll off, and now you've got a lot of new ones, that may or may not make it a very relevant example for generating average life of loan losses. A couple other things he mentioned. This one was that if the economic environment is different than the economic environment of your history, that causes a conflict as well. And to me, that seems sort of obvious. The chances of you having exactly the same economic environment for the entire time, it seems almost impossible. But so these are challenges that they recognize that smaller institutions have to face. The conclusion that we heard from Bob was, these are situations in which management will need to make significant qualitative adjustments to their quantitative calculations, regardless of the allowance estimation and a loss rate method that gets used. In the real world, management will need to document and support their qualitative adjustments. So kind of puts the burden on creating Q factors that are reasonable and supportable and documenting everything about it. And this kind of makes a qualitative change sound like a quantitative change to me. So, you might get some hints from a couple of years ago when some of the auditors came around and said, your Q factors need to be more closely tied to some sort of metric. So I think this is an area that, where best practices are certainly emerging. Mike, I don't know if you have anything you want to add to that.
Yeah, I think one way to look at it is that, you might have a Q factor for you would have to apply. Well, let's say you did a vintage analysis or what have you like that, and then you get to some loss rate, and then but you're noticing that delinquency past dues are increasing, and or your credit internal credit ratings are getting worse. Well, there is data out there that can determine life of loan loss rates by past due status or by internal risk rating. So there will be that data in there so that you can use to try to quantify those. My hunch is that an actual Q factor adjustment would come from kind of an average of the two or something like that. But that's where the quantification, I think, becomes a bigger issue under CECL here, because you actually have these other things that can measure what those Q factor adjustments would be.
Yeah, this is where the art collides with the science, right?
Yeah, definitely.
Then we talked about data needs and sources. This was directly out of their presentation, and you can see that they say you have to use relevant data about past events, including historical loss experience, current conditions, and reasonable supportable forecasts. So basically, you need data about the past, the present, and the future, which is pretty much everything. And you can see that they say data availability is a factor to consider when selecting the method that you choose. And don't wait, begin now. We talked about this already. Somewhere data warehousing is needed. Talking about those historical loss patterns or loss curves, as they are key, because they're used to compare current conditions and projections of loss rates for similar pools under similar current conditions. Again, if you're going to get third-party data, which they pretty much state that you're going to need, you're going to have to use Q factors to adjust them to your particular bank's portfolio and practices. And they kind of ended by saying you don't necessarily need to store a lot of data for CECL calculations, but you need it as far back as you can find it, because you'll need it for justification, not necessarily for the calculation itself. They did actually show some data examples. They said, here are the things that you must have. And you can see most of these are, in fact, I believe all of these do show as a CSI data field. And these are the kinds of things that we map into our solution. The accuracy of these and the quality and consistency of the coding is going to be an issue. The third from the bottom is the portfolio segment identifier. So in most cases, that's going to be your control code, but for other institutions, it may not be. And obviously, charge-off and recovery information is not always stored and available off core other than as a transaction. So most banks keep that on spreadsheets. And then the pay down by loan data, prepayments, that's something else that can be a challenge. Then they threw out some additional relevant data items. And these are some things that are pretty nebulously described. Other credit metrics, credit quality risk tracking, and my favorite, which is the last one, which is any data needed to justify reasonable and supportable adjustment for current conditions and forecasts. So there you are.
Yeah, I think when they say additional relevant data, it would seem that if it's relevant, it would seem to be a must-have.
Yeah. They went on to talk a little bit more about the challenges. This was the guy from the CSBS, and I think of the state bank supervisors as being some of the more attuned to the smaller institution. So usually when they speak about things like this, I tend to listen. He talks about turning to other data sources. This was an interesting statement he made, Kyle. He said, if you're in a weak economy, you probably should not use lifetime loss rates from a strong economy, which kind of throws the concepts of some of the patterns in question to me. So you have to sort of cue your way, as it were, to an economic adjustment to your lifetime loss rates. And this was a good one too, where he said, the methods you use may be determined by how much data is available to you. You may start out thinking one method is better than the other and find out that it just doesn't work, either because of the data issues or improperly skewed results. And finally, consider the quality of your data, how much you can rely on what is in your data systems. So these were somewhat concerning because these are the realities I think we're going to be facing.
Yeah, one thing about that comment in regards to if you're in a weak economy and not using lifetime loss rates from a strong economy, when you're in a weak economy, you're likely issuing loans only to the most pristine credit quality borrowers, right? And so that might even give support that your loss rates probably should be pretty low on those new those newly originated assets. So, that then gets to how you segment your portfolio and such. But
Mike, are
you
you trying
take
to
these
apply logic to this?
just this one time.
Okay. But it's a
Yeah.
good point. When do the bad loans get made? They get made when times are good and when there's a lot of competition and underwriting standards are loosening. Yeah, it's an interesting challenge. And again, the question came up, what if your bank doesn't have all the relevant data you need to determine life of loan loss rates? Kyle said, you need to consider peer data, other external data. You may need to consider proxies. Then there's extrapolations and interpolations. So, Mike, I'm not an accountant. I had to go look up interpolation because I didn't know what it meant. Something about
Hey, tell it to me. I'm not sure what he meant by that either.
Well, that's, man, we're keeping it simple, right? And then they say, we want a good faith effort from our banks, and we expect you to improve over time. And again, what is considered a good faith effort or a best effort is as interpretive as anything, and your auditors are going to have a lot to say about that. And again, maybe we're beating a dead horse on this, but the question came specifically, what if you've never had a loss? What if you're getting into a new line of lending and you obviously have no history of losses? And that's when Joanne of the Fed said, you would then look to market or peer data for that period of time. You start tracking it now, but you could look at peer data so you could come up with what your loss rate might be for your lifetime loss. So that was kind of a summary of that. All right, so wrapping up what they said, we'll talk a little bit finally on controls and documentation. They talk about how existing documentation, it has to be including a detailed analysis of your loan portfolio, and they give some examples of the kinds of things you have to worry about, factors that affect collectability, which would be risk drivers, as Mike mentioned before. When you do underwriting, what are those risk? Is it debt service? Is it a loan to value? Is it risk rating, collateral? And this talks about applying consistently but modified when appropriate, and being well supported in writing with clear explanations of all rationale and supporting analyses. So just a couple of comments on that. You've got to have financial controls over this data. You can't have a lot of handoffs and a lot of manual processes. Is one of the reasons why spreadsheets are not recommended. It's hard to put auditable accounting controls on a spreadsheet. I mean, it can be done, but it's a little bit easier when you have a centralized database that's locked down with rules and clear data lineage back to the source. If you now take your data out of the source, dump it into a spreadsheet, maybe credit gives it to someone in finance who then manipulates it further, you're going to have problems, I think, when the auditors come to take a look at your processes. All the decisions and choices you make have to be supportable, explained, documented in detail. You have to be able to tell the story in a way that's justifiable and reasonable. And that's, by the way, something that I don't know of any system that you buy is going to do that for you. So you're going to have to do that yourself. You can use system reports as justification, like slicing and dicing, trends, looking at particular aspects of performance, but the actual document you're going to have to write yourself. And it also says that you're going to really have to look at the best way to do it for your institution, because you're going to be concerned about things like volatility, the size of your reserve, and based on your lending process, based on your portfolio construction, it's going to be different. And all of this has to be documented in detail. And they also just made a call out to audit committees saying that they should play a major role in enforcing a collaborative effort to put all this in place. It's a significant change. I don't know, Mike, if you think there's anything we have to add to that.
Not really. No, I mean, it kind of speaks for itself.
Okay, so let's wrap this up with where do we go from here? And then if people want to hang for questions, we can take a few if you type in. I see a couple have come in, so that's great. So where do we go from here? So here's where I kind of went off the grid and thought, well, based on all the things we just heard, and based on the reality that a smaller, less complex institution has when it comes to resources and capabilities, what could we possibly take from this? So, the first obvious thing is that if you don't have enough data, you're going to have to get it somewhere else. And most smaller, less complex institutions won't have it. Um, so what resources do you have readily available? Let's assume that you're not going to go out and buy data from somewhere. Well, you're certainly going to have your individual historical losses, and you're going to have them probably defined by asset pool. So that's, just about every bank has to have that. You've done your past ALLs, you've got that historical data, so you know where your losses were. You also have access to peer data through the FDIC website. Some of you are probably doing peer comparisons as part of your board analysis. Others may not be, but there is historical data, but it's only at the call code level. But you could get information from there. You also have current and recent loan performance data. So I'm talking about probably over the last 12 months or so. You probably got some pretty good detail about delinquencies, obviously charge-offs, possibly risk rating changes, migrations, maybe even if you've rescored your loan's credit score. So you'll have some degree of current and recent data. And then you've got your future data, which hopefully, if you're hearing what we're saying to you today and you're working on this, your future data is going to be a lot better than what you have today. And one of the things Ardmore does for banks who use the CSI solutions, the first thing we do is look at your data and make recommendations to you on what you should do and what you can do, and have a meeting with you to go through that. So these are the resources from a data perspective that you have. You might have access to other third-party provided data, but sourcing this data is difficult. First of all, because there's a cost involved, and second of all, data that is relevant to smaller, less complex institutions may not be what is available in the marketplace. So this is kind of where I see things. So I came up with this idea, which is not compliant. Please do not take this to be, here's a safe harbor, here's a way to go, because I don't know, I doubt this will be considered acceptable. But we could do something like piece together historical data from multiple sources and try to sort of build this loss history with what you have. So I kind of came up with this idea saying, could we take your actual losses by pool, which you have on your spreadsheets or in your old ALLs, and then pair that somehow or blend that with UBPR data for similar pools and create that historical through the cycle history that the regulators say is what you really need. Could you somehow blend that, and would that be considered acceptable, where you could go back to 2008 so you could show through the cycle loss history by different call code assets, and is that detailed enough? And then can you augment that with recent and current risk characteristic loss detail, or downgrades, delinquencies, times delinquent, and those kind of fields, so that you can sort of, as it were, become more granular, more specifically detailed as you get into 2017 and 18. And then based on your credit data assessment of your current condition and new practices and processes, start to build towards future much better, more enhanced core data history. And then this blended historical stuff at the back will start to drop off as we go forward to 2021. This is the only thing that I can see a small complex institution can do outside of buying data or somehow acquiring it some other way through a peer group. There are obviously issues with this. That's why we have the disqualifier here saying this is not necessarily a compliant method. And I just threw them up there. There's a bunch of them. Call code level data is not considered necessarily risk characteristic driven. Changes in loss rates wouldn't be supported necessarily by any data. All you'd have would be these UVPR rates and say, that's what the pattern looks like. There'd be no way to link it necessarily to your own performance. Also, you have the whole issue of blending data with your own data and using Q factors to try to justify the blend and how to adjust for that. You're not going to have a lot of meaningful risk characteristic data under this theory, except for current and go forward. So long-term credits would not have very good information behind them. So I don't know if this is a good faith effort, if this would be considered acceptable. Mike, I know you're thinking probably auditors would not buy into this.
Yeah, that's my concern. I think it certainly would be a good faith effort, but I also think that it might be the easiest way to get some sort of estimate really quickly, because I think that, like, for example, there was a report out by Stonecastle Group that said several hundred small banks will have to probably raise capital because of CECL. Well, you don't want to be in that position where uh, you're finding out in 2020, whoops, I think I need to try to raise capital. And so getting doesn't mean that the process uh, doesn't have value. And I think that the important thing from the people listening on here is to inform their boards, what will things look like? How and so while it might not pass an audit muster, it might provide high value to the board.
All right. Thanks, Mike. So where are we as we wrap this up? Where are you? This the journey, the marathon, not the sprint, the marathon to CECL readiness. In 2018, there was a few must-dos where institutions are today. And I'm also thinking, for those that are public business entities that go live in 2020, this better be well in place. For you who are going live in 2021, these are the steps this year we think are minimal to go towards CECL readiness. And in a minute, when I describe the boot camp that we have for CSI banks, you'll see how we're focused on these kind of activities right now. The credit data assessment, changing your coding and loan information management practices, reviewing your policies and practices around your current ALLL and thinking about how CECL will affect them, starting your CECL project plan and socializing what's going on with CECL in the bank through awareness committees. Then as we go into future years, we'll be concerned about testing the models, building and buying them, running parallel, understanding what the capital impact is, and eventually coming up with a solution that is repeatable and not volatile, stable. So where you are in this journey, for those of you who are just starting, I think you've got to catch up. For those of you who are in this, what's in the red circle, you're on your way. So what we can do is we can help you with this. So I'm going to wrap with this, and I'm going to take some questions if we have them. The bootcamp solution. So we have a CSI bootcamp that is just for CSI banks. And this is for a bank that wants to start now with those early steps, but doesn't necessarily feel that they need to buy a software package to use. So what we have in the CECL bootcamp is, if you subscribe to this on an annual basis, you get a database that is a secure hosted data mart, and we have all the audit certifications for all that. It's an IBM data mart. So you can start to build your own data historical history. And in addition to that, we give you one-on-one consulting. So we'll do the credit data assessment with you and look at your data and tell you what you need to do and how you can change and where we think there are opportunities. We also have an online portal for CECL that's specifically for the bootcamp members. And with that portal, you'll be able to log in, ask questions, chat with your peers, ask experts, track threads of conversation about things like, this is what my auditor said, this is what my regulator said, I tried doing this with my consumer pool. It's an opportunity to share best practices. And then we do a series of online webinars which will walk you through those different stages of readiness with our CECL experts giving you advice. It's our responsibility, Ardmore's responsibility as the substantive expert and the credit expert to make sure we're on top of what CECL compliance means and these best practices that are evolving. You would have the opportunity at any point to upgrade to the full CECL Argus suite, called the CPM suite, that does the calculations and the disclosures. This is an example of logging into the bootcamp where you would get data validation reports from the data you've been loading, and you'd be able to go in and get involved in discussions. For those that want to use their data now while they're collecting it, we do offer the Argus CPM suite. We are happy to say, actually, we have 2 banks that signed up for this right away. We have 3 banks that signed up for the bootcamp, and we're in the process of signing up for the banks right now. If you go with the full solution, there's an automatic extract that goes from CSI to the data mart, which is also, I should state, the same for the boot camp. There's no extra charge. You don't have to pay CSI to release this data. They are our partners in this, so it's all factored in. With the solution, the software solution, you can also upload your own spreadsheets, loan origination data, loss data, and you can use it right away for reports, portfolio reporting, for stress testing, and doing your current ALLL in case you want to run parallel in an automated way. The logic of this is, if you're going to go through the effort of collecting all this data for CECL, why not use it as many ways as you can? You can build efficiencies and bring benefit to the institution. So for those that want to go the full way, we're offering the CPM suite as well. And you can see here's a screenshot of a vintage calculation that it does, where it takes your actual losses, which is what's in the beige. It gives you help for the projections with using economic forecasts, and then reverts to your loss rates for the remaining period. So that's the end of our formal remarks today. I would like to thank Mike Gillette of the American Bankers Association for chiming in with some very useful comments and some insightful thoughts about CECL. Thank you, Mike. And I'd like to thank CSI as well for hosting us. And I'm going to take a look and see if we got any questions. I don't know, Mike, if you have any closing comments that you might want to add.
Well, I think that really banks just just make sure you're go for flexibility. There are so many questions out there. You don't want to go 5 years later and say, oh, I wish I'd just collected a few more data points, which probably wouldn't have cost any more, and you didn't need them yet, but you might later. So just go for flexibility.
Yeah, I think it's a good point. One of the things that would be, I think, a bad move for an institution would be to commit to, let's say, buying a software solution that you're locked into one methodology or one set of ways to do things, because as we said from the very beginning, this is a very subjective standard with lots of options. And the idea is that the institution themselves will try different methods and use different calculations and formulas and justifications until they find the one that fits them best. So the Argus solution, for example, supports the snapshot or closed or open pool, depending on which term you use for it, the vintage, and the probability default, loss given default method. So you can try all of those and see which ones work best. I have a couple of people asking about the slides. Yes, they'll be available. You can go to me. My email is up here on the screen. You could also ask your CSI representative. If you want more information about the solutions, there's a frequently asked questions on the boot camp that you can actually download right from here, and we can also send that to you. I have a question about the pricing of these solutions. I mean, they do vary somewhat based on institution size, but the boot camp, assuming you qualify for the boot camp, which means you're at or below the $500 million asset mark, it's $6,500 a year. And so for that, you get the data mart, the automatic feed from CSI, the one-on-one consulting, and the portal, and the ongoing training. The actual application itself for the smallest institutions ends up being about $15,000 a year in total. I think we're well out of time, but I wanted to thank you for your time, and hopefully this was useful. If you have questions, you'd like more information, we look forward to talking to you, and it's our pleasure to be a partner with CSI. Thanks, and have a good afternoon.